Hi, so in this video, I'm going to talk about the financial indices you should track. In other words, what data should you be aware of that might have an impact on your investment decision? Now, I know some people don't like data, you don't like math, you don't like figures, but AI has made your life easy. If you go to bard.google.com and type in a query about any of these financial data points I'm going to share with you, AI will give you that information in a way that you can easily understand. It will generate the tables for you, generate the charts, give you the information in simple language. So AI has made your life easy, and this is for those who really, you don't have a very good relationship with numbers. So what kind of data should you be aware of? Inflation is number one, and that's because that's a challenge across Africa, and because this course is for Africans and Africans in the diaspora, it's really relevant. In simple terms, inflation is where there's a sustained increase in price. So month on month, year on year, you just find out that you have the same money, but you're buying fewer goods with the same amount of money. You're not getting enough bang for your buck, so to speak. So your money is really losing value every single day. And when you take that money, to the market, you just find out that you're not able to buy as much as you used to buy, say 6 months ago or 12 months ago. Now let's look at some real data. So this is Nigerian data. Inflation rate over the last year or so has been over 20%. Now what this means is when you're making an investment decision, any investment that doesn't give you a return of over 20%, unfortunately, it's not helping you escape inflation. It means you're really just losing value on that investment, unfortunately, because at the end of the day, if you keep that money for 1 year and say you're earning 10% on that investment, but the inflation rate is 20%. You've lost about, in terms of value, you've gained 10% in return, but in real terms, in terms of what you're going to spend that money on, you've not really exceeded the inflation rate. It's better than nothing in the sense that it's better that you got a return instead of keeping that money under your mattress or in a bank account. But the rule of thumb is, as much as possible, try to find an investment that at least exceeds the inflation rate. And that's why a lot of people tend to keep their money in stronger currencies. And we're going to talk about currency devaluation here. So if you live in an import-driven economy where the government literally imports everything, then devaluation is going to mean a lot to you. For other countries, when there's devaluation, it's good news for exporters because there's a lot of demand from other countries for locally produced goods. So really, it should be a cause of celebration for the local producers. But unfortunately, if you live in a country where you literally import every basic commodity, then anytime there's a currency devaluation, average goods just become very expensive. So this is a chart of the slide of the Zambian kwacha against the dollar. Many other African countries are feeling the heat, relative to the dollar. So it's something to keep your eye on, because if you're going to be investing in the local currency, you want to be sure that at the end of the day, you're not losing real value. Because at the end of the day, if most of the goods you're going to buy are pegged to the dollar, then the challenge is you've really lost money. And this is not to knock the local currency investment or knock any currency. But again, we're just talking about data, the data you need to be aware of as you invest. Interest rates are interesting, whether the rate at which banks borrow from each other or the rate at which the banks borrow from the central bank. What you need to know is if you put your money in a bank or you put your money in an asset management institution, and they give you the safest possible investment in that country, which could be treasury bills or money market funds. These are seen to be the safest low-risk investments. Ask yourself, does that rate exceed inflation? If it doesn't, again, like I said, not bad. At least it's better than putting the money on your, under your mattress. But it just tells you that even though you're earning a return, you're not really beating the inflation rate. And sadly, this is why a lot of people tend to do higher risk investments or become victims of Ponzi schemes, because when they look at the safest investments that are available, those investments don't beat currency devaluation rates, they don't beat inflation rates. And that's just, a bit disheartening if you have a low risk profile. So in summary, if you really want to calculate the real return on your investment, it must be greater than inflation. The inflation rate at least must exceed the money market rates, which is the safest rate you will get from a bank or an asset management institution, and then calculate the rate monthly. And I'll explain why. So sometimes you see an investment that says, oh, this investment will give you a return of 35% in 12 months, and then another investment will give you 30% in 9 months. And immediately you look at the total, 35 seems larger than 30. But by the time you divide 35 by 12 and 30 by 9 and look at the actual return month on month, you'll find out that it's better to do the 30% return in 9 months than the 35% in 12 months, because you've now looked at the real monthly return. So again, anytime you're faced with an investment decision, don't just look at the overall return over the long period. What is the monthly return? And always go with the investment as much as possible that gives you the higher return on a monthly basis, especially if you're going to compound that investment. So if you look at the very bottom of the chart, if I were to compound, the first investment, over a multiple period, say over 24 months, and then I were to compound the other investment, over 18 months, again, the 18-month investment beats the 24-month investment on a monthly basis. So that's why you need to just quickly do that calculation before you make a decision. Don't just look at the total. Now, the stock exchange index is also another thing you might want to pay attention to, and that's because an index tracks the performance of an overall industry or sector. So you hear things like, S&P 500 for the US, which tracks the top 500 stocks by market capitalization. In Nigeria, you hear about the All Share Index, which tracks all of the stocks on the Nigerian stock exchange. So sometimes when you look at those indices, it's really just to give you a sense of how is the market performing, how is an industry or how is a sector performing, and then you can decide, I think I'd rather invest in tech stocks, or I'd rather invest in banking stocks, or I just want broad exposure to the entire exchange. So that data is very important. It also helps you spread your risk, because some people don't want to buy individual stocks. You're not a stock trader. That's not your profession. So you're not going to do the deep dive analysis into individual stocks. You're not going to read earnings reports and annual reports. So you just want to spread your risk, by placing a pool of funds across a broad index. So find out what is the performance of the stock market as a whole. And then some people may say, I want to know what the top 30, top 50, top 100 stocks are doing. I want to know what's happening in banking or industrials or tech or AI. It's just interesting to find out that data, because when you then look at the comparative data, let's use Nigeria and the US. So the Nigerian, All Share Index, which is an aggregation of all the stocks on the Nigerian Stock Exchange, over the last 10 years. So if we just annualize the results from, say, 2012 to 2022, the annualized return, if I just look at what the annual return has been over that period, it's about 3.5%. And then if I zoom into just the top 30, so let's see the biggest, stocks by market capitalization, just the top 30, over the same period, it's performed 9.3%, 9.37%. Then if I zoom into banking alone and I say, let me just look at the top 5 banking stocks, the performance is 11.67%. But the sad news is if I look at devaluation, currency devaluation over the same period, it's 12.5%. So it means I've actually lost all that value over the last 10 years simply because of currency devaluation. If I put that same money in the US stock exchange, say the S&P 500, which is an aggregation of the top 500 stocks by market capitalization, on an annualized basis, I've earned 12.8% in USD. So you can see the difference. It's sad, but that's what data does, because when you get the data, you can then decide, how do I invest? And it's up to you. You can take the decision, because the good news, say about let's just even stay on the Nigerian Stock Exchange. In 2020, for example, during the height of COVID-19, the Nigerian stock market was the best performing in the world. It returned 50%. So what that data tells you is that you might be better off just trading on the Nigerian Stock Exchange rather than holding for a very long period of time. So you might just focus on opportunistic trades, but you may decide that, on the US Stock Exchange, you can then do a long-term hold for 10 years because you've looked at the data. So that's how you kind of use data to make informed investment decisions. Same thing with cryptocurrency. It helps if you look at an index, a cryptocurrency index, it helps you just track the highs and lows. You kind of know, you're not trying to time the market, but at least you're able to see, say, over 5 years, over 10 years, what has the performance of cryptocurrency been like? And because cryptocurrency is traded 24 hours a day, 7 days a week, unlike the stock market that only opens during work hours. You can't trade on the stock market on a weekend. You can't trade on a stock market after hours. But cryptocurrency is 24/7. So it's very sensitive to markets and time zones. So while Asia is waking up, the Asian cryptocurrency market is active. And then when the US wakes up, the US cryptocurrency market is active. But one of the things you can do, again, the same thing we did with stocks. If you look at the top 10 cryptocurrencies over the last 10 years, annualize the results, you will see a return of over 300% just over that 10-year period. So again, it may make sense for cryptocurrency because it's a very high-risk investment. You may decide not to buy individual cryptocurrencies and just put small amounts of money. We talked about dollar cost averaging before. Small amounts of money every month for the next 5 years. And don't put all your eggs in one particular cryptocurrency. So you could say, let's just do the top 10. Small amounts over the next 10 years. And that may be, your strategy for investing in cryptocurrency. It's high risk, but you're spreading your risk across an index. And that's the beauty about index funds. That's the beauty about exchange traded funds, which is also just an aggregation, of different stocks in a particular industry. So whether it's called an exchange traded fund, it's called an index fund, it's really the same principle. You're just aggregating stocks that belong to a particular industry or a particular sector, or you're aggregating top 10, top 30, top 50, top 500 across the entire exchange. And that's a way to invest in high risk assets while spreading your risk. So that's really the summary or the lesson of this video. And then finally, track food prices. The good thing about tracking food prices is that for those who do a lot of agriculture investment, food commodities investment, you want to be aware of the seasons. So a lot of food commodities track a particular season, dry season, wet season, particularly in Africa. So you want to buy when the price is low, sell when the price is high. There's some goods that you kind of know because Africa is very religious. So every Christmas, certain food prices go up. Every Ramadan, certain food prices go up. So if you're that sort of high risk investor and you want to participate in food commodities trading, you kind of then just need to track those seasons and then track the prices across those seasons. So that's it. Thank you for watching the video, and as always, shoot me a social media message. I'm available to take your questions. Thank you.